You're watching Economics Amplified, the latest thinking on the biggest issues from UChicago's Becker Friedman Institute.
Thank you, Lars. Lars, you've heard already two versions of this talk. I gave a serious talk to the mathematics department on the mathematics behind this stuff. Then I gave a talk to friends at BFI to help us have places like this. And Lars came to both of them. So I think he doesn't need to listen to a third version of it. You can go and work. The main reason I came here was that we're doing some joint research, and we spent most of the week in a room working together and so on. So I know that Lars's normal life is disturbed by my visit because we've been working very hard on this stuff. It's also a great pleasure to be at the University of Chicago. This is truly a remarkable institution. As Lars said, I was here for a long time. I left for personal reasons, but I've always think of myself as a Chicago economist. And that's a lot of what is behind here is this Chicago attitude of how to think about economic problems and so on is going to, I hope, become apparent as I talk about it. I want to reserve some time for questions, so I'm going to go, for a certain amount of time, and you guys have to think of reasonable questions, otherwise I'll be not happy. So, when I teach, that's one of the things I always like or incentivize my students to make our questions, so you guys should be ready to make them. But Lars mentioned already that the history of financial markets are dotted with the episode described as bubbles, periods in which asset prices seem to vastly exceed fundamental, but economists don't really understand what are the economic mechanisms that generate such episodes. And I'm trying to talk about today, part of my research is getting a little bit away. Of course, a bubble is a price phenomenon. We understand that. But it's my view that if we just think about prices are too high, they are too low, etc., we're never going to get much, we're never going to advance much on the topic. So the idea is to think about additional empirical regularities, that these regularities will help you determine what are the reasonable mechanisms to generate bubbles, something beyond prices or something in addition to prices. So I'm going to do today, this is my plan, I'm going to present some stylized facts concerning bubbles. I'm going to discuss a particular model of bubbles and argue that fits the facts that I'm going to raise. I'm going to present some additional evidence, and then I'm going to discuss some policy questions. What do those things mean about the world, and whether there's anything we should do about these phenomena? So I'm going to start with three stylized facts that I want to emphasize. First is that when episodes that we call asset price bubbles coincide with increase in trading volume, I'm going to argue, I'll give you some examples and so on. The second is asset price bubbles, implosions, seem to coincide with increases in the asset supply. The story here is that bubbles end not because people all of a sudden decide, oh, that's a bubble, let me stop paying so much for the stuff. It's a very normal economic reaction. If there is a bubble, people are going to try to profit out of it. And one of the ways to profit is to create assets that people are going to value a lot. Okay? So that's an old mechanism, the market reacting to what they're observing. And the third is that asset price bubbles often coincide with financial technological innovation. There are others that people mention, price volatility, etc. Those are less clear, so I'm not going to use them in this discussion. So I'll start by giving you some examples of things that we have been deemed as bubbles and how do they fit these facts. So the earliest bubble for which we have data is something called the South Sea bubble. The South Sea bubble was a very short phenomenon. It only lasted about 8-9 months, started in early 1720, and by the fall of 1720 had finished. And there was a company called the South Sea Company, and its stock rose extraordinarily, tenfold during that period and crashed back. But there are all the similar joint stock companies that are in that same year. One of those companies still exists. It doesn't exist as a company anymore, the Bank of England. And for that, we have a lot of data. Bank of England, of course, was a private company. Now it's part of the British government. So the Bank of England stock in 1720 traded used to trade before the 1720 episode, about 2,000 transactions a year. And in 1720, it traded almost 7,000, which was about 100% of all the stock existing. Now, if you understand the technology in which they traded stocks at that time, you went to a place, you wrote into a book. The book sometimes they were in vacations, for instance, sometimes. So sometimes you only got possession of the stock or the right to resell the stock like a month, 2 months, sometimes 3 months later, sometimes a few days too. But nonetheless, 100% of the stock got traded. There were other companies were the same type. The East Indian Company is one of them. There was a very famous company that traded with what was then called East India. The Royal African Company that traded with Africa. All these companies traded a lot. And the references here from historians, Carlos Nguyen, I cannot pronounce that last name, the third author. Okay. Now, I want to go to another episode much later, which are the Roaring Twenties. So there was a big stock market boom in the late 1920s, and especially in the years of 28, 29, that led to the crash. Now, before 1928, the annual turnover, that is the amount of stocks that changed hands relative to the amount of stocks existing in New York Stock Exchange, climbed from 100% per annum to 140% in 1929. Now, the United States is about the only country in the world where we still measure, if you open up the Wall Street Journal, or nowadays nobody opens up anything, but if you go into their site, you see they have a number of trades of shares traded. So they announced today they traded so many millions of shares. Turns out that most other countries don't do that. They talk about value. For whatever reason, we have a tradition of talking about numbers of shares. Now, in 1928, the number of shares traded beat daily record 10 times. In 1929, another 3 times. So we had 13 records in these 2 years. The next time we had a record trading volume was in 1968, so it took 40 years later. And it was a very special day in American history. The President of the United States, Johnson, announced he was not going to run for re-election because there had been a lot of protests against the Vietnam War. And so he announced finally he wouldn't run, he would not try to get the Democratic nomination. So that took about 40 years. So that shows how big those numbers were for that period. Now, the next episode I want to mention is the dot-com bubble that occurred in the very late 90s, early 2000. During the dot-com bubble, internet stocks had 3 times the turnover of other similar stocks. Set the other stocks, which I want to mention, talk a lot about it here. You were all too young for this, but there was a time where before iPhones, there was something called Palm Pilot. Maybe if you go to a museum, you can find a Palm Pilot. A Palm Pilot was basically an electronic agenda that we all had to keep track of. There's no phone attached to it. It was just an electronic agenda. But it was a very hot thing in 2000, okay? And a company that produced it, actually, a company that came up with it actually was a Chicago company. It was called 3Com. And 3Com is an even older technology, things called modems, and which you attach to your phone to send, one-line emails. It would take you a while for it to go. And so this company split in a way that you had some investment banker told those guys, you can have 3Com stock or you can have Palm stock. Okay? So initially there was one company called 3Com who owned the Palm technology. Then they had this brilliant idea, we're going to spin off Palm. And Palm became a super hot stock. But the interesting thing is that there's a lot of interesting economic phenomena around that, but I'll get to that. I won't have time to talk about it. But this Palm stock was trading 38% daily. Just to give you a normalization, the typical New York Stock Exchange stock trades 100% a year. Okay? So you get 38% daily and 250 days a year. You see this stuff was trading basically 100 times faster than the normal stock. That's just one example. And so on. Now, John Cochran, who of course is at business school here, has done some work where he looked at stocks, during the internet bubble, look at the market to book value, that is the ratio between market value, how much it was worth in the stock market, and the book value, how much accountants thought it was worth it. And so that was very well correlated with the stock turnover, how fast the stock traded. Okay, so that's kind of a general phenomenon from that period. Now, let me get to the idea of asset price bubble implosion increases in the asset supply. In 1720, the South Sea Company itself issued a lot of new shares, and a lot of other companies were issuing shares. But the most interesting phenomena is the phenomena that gave the name bubbles. Okay, the name bubble, which we use today, comes from this episode. And so what happened in 1720? In 1720, a lot of people realized, the South Sea Company is selling this stock at these very high prices. So why shouldn't I start a company to sell stock at those very high prices and pocket the money? Okay, so there's a series of companies. Now, unfortunately, some of these, there were so many of them, and some of these stories were written much later, so we're not really sure that they're all true. But the one I like best is about a company which decided that they were going to produce square cannonballs. Now, if you understand a little bit of physics, you say it's not a good idea, but apparently they were selling stock. It looked very, those are going to be easy to stack. You can put them together and so on. You're going to sell a lot of them, and they sold stock. Apparently, that's related in some of the, later narratives. But it's very interesting that the South Sea Company completely understood that. And at that time, the British Parliament was not different than some of the things I'm from South America. I was born in Brazil. Some of the things we hear about Latin American parliaments sometimes, or African parliaments, the British Parliament was very corrupt. So the South Sea Company went to the British Parliament and passed a law making it extremely difficult to create new stock companies. They wanted to keep the monopoly. And as soon as they got the law, they went out and started suing these other companies that had opened up and saying you cannot sell stock because there's a law that says you can only sell stock if you have a royal charter. It was a new law, so they started suing them. So at least these guys understood that the increase in supply was a problem for them, was going to make their stock less valuable, and that's exactly what happened. The dot-com bubble that happened, as I said, in the 1990s, something very similar happened. A lot of companies people started, first of all, a lot of insiders started selling the stock they had, but also a lot of companies were just simply changing their names to reflect the dot-com personality. Okay? And when they did that, of course, the stock price went up. We have data on that. And this was another example where the implosion was caused by the increase in asset supply. I'll talk a little bit about a credit bubble, but I'll talk about this a little bit later. This credit bubble that, even for you guys, that's old history, but it's rather recent history. The credit bubble, they imploded in 2007 and 2008, and I'm going to talk about this a little bit later when we have some more stuff. Now, the story of new technologies is very clear. We had stock market bubble when railroads appeared. On railroads, electricity appeared, automobiles, radio, microelectronics. Even the US credit bubble that we've been talking about, there's a lot of talk of new financial management techniques that really taught people, and new credit instruments, in fact, that allowed for much better risk management and lower risk premia. So there was some kind of technological innovation. Now, if you think of this, you realize that bubbles may actually generate benefits. That's the first lesson you want to think about bubbles. The fact that railroads, companies that produce railroads and companies that produce electricity or automobiles or radio or microelectronics or personal computers or biotechnology or the internet got capital cheap means that we have had growth, we have had technological progress that perhaps we wouldn't have had if these companies did not have access to that capital. So the fact that today you have, for instance, Google is a post-bubble company, but a lot of that technology was created at that time. Okay? And you may not have had such good search engines, or it may have taken much longer for those search engines to be developed if the capital markets had not priced so highly these innovations, Now, there's a difference. Not every bubble is like a technological innovation. Credit bubbles tend to destroy the financial system, and typically they have very costly alternatives. Now, let me talk a little bit about the way economists think about bubbles. I'm going to start with the oldest theory about bubbles that perhaps some of you may have seen in some of your courses, which are the so-called rational bubbles. In a rational bubble, what happens is that we pay more than its fundamental value. So today, let's something that's worth 10. Why are we willing to pay 11? We're willing to pay 11 because we believe, let's suppose just for simplicity, the rate of risk is 10%, just in our heads, okay? That tomorrow, even though I pay 11 for it, tomorrow that asset is going to be worth $11.11. So even though it's only worth 10, I'm willing to pay that extra dollar because I'm going to get the natural return for that dollar because the price is going to go up. Why would tomorrow that price go up? Because people tomorrow would believe that a year from then, I'm using tomorrow as a year, 10% is the interest rate for a year, right? A year from now, people will be willing to pay another 11.11 cents and so on, and this would compound, okay? And so that people would have every day a view that they are paying something which is above fundamentals, but they're getting a reward for what they're paying above, which is equal to the reward they're getting for buying for what they're paying for the fundamentals. Okay? So if that's correct, there are two things that happen there. First, there's no reason for people to trade. Everybody agrees, right? It goes from 10 to 11.10, 11.1. But when it goes from 10 to 11.1, I'm just as happy holding, and Lars is just as happy holding it as he was before. Okay? So there's no reason for people to trade. This theory doesn't predict any trading. The price just goes up, and people are just happy to hold the asset. The other big difficulty it has is that what about if we know that a certain date, okay, the fundamental value is going to be reviewed, and everybody's going to receive cash and go home? Then there is something you may have learned in some of your courses called backward induction reasoning. Start at that date. Well, that day you know the price. You can't have anything above the fundamental. What happens the 1 year before? Well, everybody knows that next year you're only going to receive the fundamental, so you can only pay the fundamental discounted. So nobody will pay extra. So that bubble cannot exist for an asset unless that asset at least potentially has an infinite life. So anything having to do with credit, where you usually have a date in which things are settled, does not fit that theory. It fits stocks. It could be happening with stocks. What it doesn't fit on stocks is the trading volume. So that's an example of what I'm trying to push here. This idea that you have to look at other things besides the price rise to understand what kind of causing a bubble. The so-called rational bubble theory has a problem. It cannot explain this increase in trading. Whatever trading would occur without the bubble should continue to occur. Okay. There's other theories which I think they are very interesting from a verbal point of view, but nobody has been able to do it much with it. And an example is Schiller theory, where there's a positive shock which is amplified by extrapolation of past returns. So all of a sudden, prices go up, and people look at prices, yes, and that means the prices will go, they feel, oh, prices are going to go up tomorrow, they go out and buy. To make that a real story is a little bit difficult. It's a good story to tell, but it's harder to really formalize. And then there's a set of theories, which is the one that I'm talking about here. The one I'm talking about here fits into that set of theories, which is so-called limited arbitrage, which says the following. There's an asymmetry between the cost of buying an asset and the cost of going short an asset. Now, I'm not sure you guys know what going short an asset is, but when we write economic models, like the CAPM and so on, we assume that individuals can buy either a positive amount or a negative amount of the asset. In reality, you cannot buy a negative amount of the asset, because think of it. Think of a treasury bill. A treasury bill is an instrument by which the US government borrows. If I could buy a negative amount of treasury bills, what would that mean? I'll be borrowing money with the same rates as US Treasury. That would be a fantastic universe. I could become very rich that way. I could just put the money in the bank and earn the difference. But don't believe on it. I couldn't do it. Having said that, the first thing is there's a symmetry between cost of going long and going short. And the second is the idea of heterogeneous beliefs, that people disagree about the way that assets are going to pay off in the future. Okay? That may sound completely natural for you, but I'll tell you that both of those things are kind of not very much used in economics, and I'll argue why. As I said, the principal assumption are costly shorting, and I'll talk a little bit about that. And the second is heterogeneous beliefs. Now I'm going to have a specific form of heterogeneous beliefs. You could have other forms of heterogeneous beliefs. I'm going to think of heterogeneous beliefs that arise from overconfidence, the tendency of people to overestimate the precision of their knowledge. I'm going to discuss a little bit of that with you guys. Now, of course, economists are not like that. Professors, we're very modest. We never overestimate the precision of our knowledge. But most people do, as I'll argue with you guys. None of those are standard in economics. If you've taken some advanced economic courses, you see, first of all, we typically assume symmetric costs between going long and going short, in spite of the example I gave you, treasury bills. Okay? And we had a lot of theories saying that rational people cannot agree to disagree. I'm not going to get into that here, but there's a lot of interesting economic reasoning that rational people cannot agree to disagree. Okay? And Canero, this leads to so-called no-trade theorems. We should never trade by difference of opinion. If you want to sell, it's the Groucho Marx story, right? Groucho Marx stories. Nobody wants to belong to a club that admits them. And in trading, that would mean if you offer me something to buy, to sell at a price, I should understand that stuff should not be worth more than what you're willing to sell it for. Okay? So that leads to agreement. So that's, economists tend to have a lot of theorems like this, but I'm going to get out of this world. I'm going to force disagreement. Now let me tell you a little bit about costly shorting. What is the difficulty in shorting? So one of some obvious cases, housing is an example. It's very hard. I may believe that Lars's house is overvalued, but I can't short it because when they come collect the house, Lars is living there. So I don't have Lars's house to sell as a short. Now, there's a lot of discussion of stocks. Stocks are more complicated because they are shorting mechanisms for stocks. But there's a lot of evidence that people either shorting is costly or that shorting is a risk that people don't want to take. For that, we'd have to go more into the mechanisms of shorting. But let me give you, there's a couple of papers that show this. For instance, if you were to short, this is some work I've been doing, just look at some data. It's not, I wouldn't call that work. This point is just to motivate some stuff that I want to do. If you look at the stocks that are shorted mostly, that you see most people shorting, okay, and then you look at the rate of return that those people get exposed when shorting those stocks, that's very high. It's about 18% a year, even compared to whatever risk there is. So the question is, why don't people do more of that? Okay, so mostly when we think about something that you're making money, your first reaction should be, there's a risk there that I don't understand. So one of the things I'm trying to do is understanding that risk, but clearly there's a risk there. Otherwise, it's kind of a free lunch. Let me talk to you a little bit about overconfidence. There's a lot of psychological literature that people overestimate the precision of their knowledge. I list here a lot of psychology papers, but what I really like is some work that has been done recently. So Duke University, for the last 10 years, between 2000 and 2010, the papers from 2010, sent a questionnaire to CFO of about 1,000 medium-sized and large companies. Okay? In that questionnaire, they asked a bunch of questions, most of which don't matter for us. But among these questions was a very interesting question. They asked the executives to give them two numbers. One number, there was less than a 10% chance that the stock market return would be below that number, and another number for which there was less than a 10% chance that the stock market would make more than that number. Okay? So CFO could answer, okay, minus 2%, which means I think there's a 90% chance that it's going to be better than minus 2%, and maybe 10%. So this means I have a 90% chance that it's not going to do better than 10%. So statisticians call that the 10-90 interval. So the interval which goes between 10% and 90%. And what is the probability if lots of people are kind of unbiased and do give you this 10-90 interval? Okay, what should be the probability they are right exposed? Remember, there are 10,000 people making these predictions, right? So what's the probability that they should be right exposed? So if you took all of them and say how many of those 10,000, the actual change in the S&P, by the way, this was about the stock market with the S&P index, right? The actual change in the S&P index, how many of those people should catch the actual change within that interval 1090? Any takers? 80%. 80% of the people should have caught them within the their 1090 interval. In reality, only about a third did. So most people gave too narrow an interval. That's what overconfidence is. They thought they really knew where the stock market was going, so they only got it right a third of the time instead of 80% of the time. That's one of the things of the neatest demonstration of overconfidence. And those are CFOs, people that should know something. Maybe not. So let me spend a couple minutes on the sketch of model, okay, to discuss how you think about problems like that. So we're going to have a bunch of investors. And there's going to be two groups of investors. So Grace, there'll be a lot of copies of Grace. I know she's your boss, so you can imagine a world with like lots and lots of Graces. Okay, so she'll be one group, okay, and I'll be the other. Another group will be lots of copies of me. So we're trading with each other. We're looking at signals, okay, and different signals. People are going to attribute different informativeness to different signals. So in a good world, both Grace and I, we disagree. We may be both rational, to a certain extent, but we disagree. So we're rational to a certain extent. I tend to overvalue what my friends tell me, and Grace tends to overvalue what her friends tell her. And if she puts a lot of weight on those signals, she's going to look overconfident. So she's going to look like she knows more than she actually knows. She thinks she knows more than she actually knows because she thinks that those signals her friends are telling her are very valuable. I would do the same thing, but I would be looking at different signals, what my friends tell me. So when we meet, okay, we're going to have different opinions. Both of us will be too sure of ourselves because we'll be looking at these signals that we shouldn't put that much weight. I'll put too much weight on my friend's signals. She's going to put too much weight on her friend's signal. There's another version, which is kind of more fun to tell, but not necessarily the truth. The theory doesn't depend on that. Do you guys know who Jim Cramer is? The guy who screams on television. So let's assume that Grace knows that the guy is just screaming. There's nothing to it. But I think the guy knows something. So every time Jim Cramer screams, buy the stock, I say, he's right, because Jim Cramer is always right. And I really trust that signal. So I tend to want to buy that. I create a demand for that stock. Okay? So that would be another version. They're all the same from a mathematical point of view. It's just a bunch of equations. It doesn't matter. Okay? So I'm not going to have any. So that is. So at least some investors overestimate how much they know. There's no learning about overconfidence. That is, there's no learning in this model. As I told you, bubbles are fairly short phenomena. 2 or 3 years it stops, the ones that we have observations. Okay? And being very important is both Grace and I know that our relative opinions are going to fluctuate. Sometimes I know her friends are going to say something good about the stock. She's going to become optimist about the stock. And she knows that sometimes my friends are going to tell me something about the stock, and I will become optimist about the stock. So that's the way it behaves. When Grace is thinking about buying a stock, she's thinking the following, okay, let's go back to Jim Cramer's story because it's more fun. Not my friends, but Jim Cramer. So Grace is thinking of buying the stock, and she's saying, I'm going to buy the stock. It's only worth $10. But maybe I'll pay 11. Why would I pay 11? Because tomorrow, José may turn on the TV, Jim Cramer may say the stock is great. He's going to be willing to pay 12 for the stuff. The market, there's lots of copies of José competing with each other. They're all going to say, because I can't be the only person who listens to Jim Cramer. There has to be a lot of people in order for the story to make sense. We're going to raise the price to 12. So Grace will say, well, I get the option to resell this asset to José. And that option is worth some money. And that valuable option is what she pays for, in addition to the 10. So maybe she pays 11. Okay. I am on the other side. I'm now thinking, Jim Cramer told me that stuff is worth 12. Should I pay 12? I'd say, well, yes, 12 is what Jim Cramer told me the thing is worth, so I'm willing to pay at least 12. But suppose tomorrow, Jim Cramer changes his mind. So that's a bad event, of course. I'd like to sell my stock. Maybe Grace, who never turns on the TV, never listens to Jim Cramer, she would say, oh, the stock is great still worth 11, even though Jim Cramer told me it's only worth 6. So now I have the option to resell it to Grace. So we both have an option to resell because we know we're going to disagree in the future. Okay? And that option, the value of that option, is what gives an extra value for the stock. Okay? And I'm going to call that value of the option the bubble. It's not, the bubble is not because I'm optimistic or because Grace is optimistic. The bubble is the value of the option of reselling to the other party in the future. So the more overconfident I am, first, I have higher prices. Okay? Why? Because Grace and I are going to diverge more from each other. And remember, the guy who's going to buy the stock, hold the stock, is the most optimistic of the two always, because he's going to bid against the other one. So you get a higher price because you're getting more divergence. For the same mean, you're getting a higher price. The other thing you have higher value for the resale option, because I also know today that it's more likely that Grace and I are going to disagree a lot in the future, that when I think it's worth very little, she may be thinking it's worth a lot, so I'll be willing to pay more for that. Okay? Also going to have more volatile relative opinions, because of course, the more we trust these signals, which we shouldn't trust so much, but they're different signals, okay, the more our relative opinions are going to fluctuate. So it is the more of an opportunity I'm going to have to sell to Grace, but also the more I'm going to trade with Grace, because there will be more opportunities to trade. Now this option, when I buy this option, I'm waiting for Grace to become optimistic. And my cost of waiting is my opportunity cost. That could be doing something else with my money. And that opportunity cost says that the lower that opportunity cost, for instance, the lower the borrowing cost, the more this resale option is valuable, because I'm willing to wait more for Grace to become very optimistic. If I have a shorter horizon, of course I have fewer opportunities to resell, so to get a smaller bubble. And when investors have a limited capacity to bear risk, which is how the real world works, we all have limited capacity to bear risk. Okay? An increase in the supply of the asset has necessarily to be absorbed by less optimistic individuals. So right now I just think about Grace and I, but think about all of us, and we're all ordered by the distance from me, just to make it simple, by our optimism. And we only have $10. So we can only put $10 on the stock. So the marginal buyer, the last one who buys, which is the least optimistic among the buyers, okay, the more optimistic already bought it, okay, the marginal buyer is going to be a person who is less optimistic if there's more of the stuff to buy. If there's only 10 shares, only the 10 more optimistic people are going to buy. The marginal buyer is going to be the 10th most optimistic in this room. If there's 100 shares, assuming there's 100 people here, it will be the 100th more optimistic, which will be a fairly pessimistic person. Okay? So an increase in the supply has to drive the price down because less optimistic people will, and also diminishes the value of the option. Because, of course, at the time, you know that when you're going to sell, you're going to have to sell to a less optimistic person. Okay? So that's this mechanism I talk about. You increase the supply, the bubble contracts. So I want to show you an example of a bubble. This one, I guarantee you, was a bubble. It's an interesting bubble because it occurred in China, in a place where a lot of these assumptions, I think, are quite reasonable. First of all, it's completely illegal to short. Okay, you couldn't short these assets. So I tell you the way these assets work. So in China, around 2005, 18 Chinese companies issued put warrants. I tell you what a put warrant is. That is, if you bought this piece of paper, you had the right to sell back a share of the stock of that company back to the company for a fixed price. Okay? So today, Apple Computer is selling for $120. You could have a warrant. Those things don't exist with Apple, but you could have a warrant to sell it back to Apple at $100. Today, you wouldn't exercise it, but that would have value because if Apple ever dropped to 80, essentially you'll be selling that stock to the stockholders of Apple who don't hold that warrant. Okay? So that exists in the United States sometimes. And so these 18 companies issued these put warrants in late 2004. So they traded, they had 2 years of life, most of them, some 18 months, some 2 years. So for 2 years you had that right. Now what happens is that in 2005, the Chinese stock markets, like often happens, had a boom. Now remember, you have a put warrant, you have the right to sell a stock. So let's suppose the stock was worth $10, I do it in dollars, and pretty soon I'm going to change currencies, but it was worth $10. You have the right to sell it at 8, that's worth something. Now the stock goes to $50, the right to sell it at 8 for the next year worth very, very little. Okay? And there's a mathematical way of calculating this. What is the undergraduates, I don't know what the undergraduates have seen it, have heard about the Black-Scholes formula. So the Black-Scholes formula is a formula that allows you to calculate the value of an option, and in particular of a warrant, if that option, if you know the volatility, if you know some parameters related to that option. Let's leave it there. Wei Xiong and Jiang Yu looked at these warrants and said, look, if the warrant had a value according to the formula, should have a value which was 5% of a penny of a yuan. Yuan, of course, is the currency of China. At that time, was 8 yuan for $1. So think of it. A penny of a yuan is essentially 1/8 of a penny of a US penny. Now you take 5% of that, that's a very small number, it's a very small value. And declare if you're worth that much, that's like 0. Okay? And then they compare the price that they were trading for several yuan. The other interesting thing is that that stuff was trading 300% a day. So if there was 1 million outstanding warrants, you had 3 million warrants traded that day. So obviously people were trading that same warrant several times a day. Otherwise you couldn't do it. People were buying and selling the same piece of paper several times a day. Now remember, just to give you, I already told you this, but I want to repeat it. US stocks trade 100% a year. That's 300% a day. Okay, so it's about 750 times faster than US stocks. So they identified the bubble as the price of a warrant, and one thing is that you look at this panel of warrants, so there are dates and there are names of warrants. Okay? So there were 18 warrants for many, many days, and you can try to correlate how much a warrant is worth relative to its true value, which was 0, you know, its price, with how much of the warrant existed. In finance, we call that the float. How many warrants were out there? And the larger the float, okay, you had a smaller bubble, which is exactly the thing, because you had to have less optimistic people buying. So here's a picture of one of them. It's a liquor company, I found out. And what this picture shows is here. Here is the Black-Scholes price. So sometime in the winter of 2007, that price reached 0. Okay, essentially 0. Excel would always plot you something, but that's a 0. Okay. Nonetheless, it was trading for several yuan. It's here. Of course, as you get closer to expiration, the price went down as you'd expect. Okay, so that's the kind of picture that you get. I want to analyze the last couple of minutes by talking a little bit of the lessons we get from that. The first thing, you have to be modest, okay? We use the signals. We found this, you know, this is actually work by other people that shows you that you have these other signals when you have bubbles. You have a lot of trading. You have this frequency that happens with innovations. And you have this association between the supply and the size and the implosion of the bubble. Now, the important thing to know is that we know next to nothing about false positives. That is, we don't know how many times those things happen and nothing happened to asset prices. Okay, the typical paper says, oh, this is what happens in this episode, and these other things happen too. But of course, to be useful as a signal, you have to start with those other things and show that that is associated with episodes of credit bubble. The second thing, it's not obvious that you should try to stop all bubbles. And a lot of technology, of association between bubbles and technological innovation suggests that we should not be, bubbles have some kind of positive role. credit bubbles are different because they usually have distressing consequences after they destroy the banking system in a country. So I want to finalize here by discussing one particular episode in our recent economic history. And I'm going to have to explain to you a little bit about what those things are, but I think it's worth explaining. So in the early 2000s, there was a very active market on mortgage derivatives. Okay? The way the things work is that if you bought a house, the bank issued you a mortgage. Bank issued a mortgage, right? Which meant you had to pay a certain amount every month back to the bank. The bank would take all these mortgages together, put into a pool. Okay? And people could buy shares of this pool. The idea is that these mortgages now, there was kind of a risk pooling because everybody was going to get just a piece of every mortgage. So your mortgage and 1,000 other mortgages will be put together into a single security, and the buyer of the security will get a little piece of, or pieces of the security, could back 100 securities, but everybody will have the right to a little piece of every mortgage in the pool. Those are the first securities they happened. But then people said, well, that's okay, but let's create like a nicer, some more fancy securities out of that. I'm going to take this pool. Is there a, here. I'm going to take this pool here. Then normally, let's suppose you should pay me $100 a month just for $100,000 if you want to be fancier. Let's say $100,000. Okay? And right now, there are 10 people, each one gets $10,000 a month if the things are paid. If they're not paid, they don't get it, right? So they have a certain amount of risk. But now I'm going to divide this differently. I'm going to create two pools out of this 100,000. This pool here, the first 50,000, is going to have the right to the first 50,000 that gets paid into the pool. And the other one is going to get the second 50,000 if they're paid. Now, if you think about it, the first one had very much lower risk because even if 50% of the people defaulted here, you still get the full money. In order for them to lose money, you had to get 51% of the people default because they had the right to the first 50,000 that showed up at the bank. You wouldn't have any particular correspondence, right? So this is what these CDOs were that you may have read in the newspapers about. Those were the CDOs. So the CDOs were saying, look, this stuff is very safe, right? We're going to have a lot of defaults before that happens. And these very safe things had a lot of demand. They got rated very highly by the agencies. They got AAA rating, and they got a very high demand. So everybody was by people who wanted to buy safe assets. In particular, when people ask in Wall Street who's buying those assets, their answer was always the same: Düsseldorf. What they mean Düsseldorf is that there was some German bank buying it, not particular in that particular town, but that was the term they used to use. Düsseldorf is buying this. So Düsseldorf, but they were not the only ones. Lots of people bought these assets. Apparently, it was supposed to be very safe all over the world. And the only way an asset like that could be created at that point is that you have to go build new houses at that point. They were building lots of new houses in Arizona and places like this. Selling those houses a relatively good deal because the financing was very cheap. So lots of people wanted to get into because financing was very cheap. Why is financing was very cheap? Because they were using those pools to create this stuff, and Düsseldorf was buying it at very good rates, paying a very good price for those objects, thinking of those things as being very risk-free. So create a whole machine there where houses are built in Arizona, mortgages are issued by bank, mortgages are put into pools, pools are made into CDOs, CDOs are sold to German banks and come back, and the money will continue and so on. I mean, not only German banks, of course, but this was what people used to talk at the time. So some people had the idea that they could make money if they just could create something that looked like a CDO, but did not need to go through all this building houses in Arizona and so on. So, lots of people had this idea, you know, but the guy who became most famous was a guy named John Paulson, was not even an originator of the idea. If you read Michael Lewis's book, you see he was one of the people who had the idea, but certainly not the originator, or he heard about it and so on. Made a lot of money out of it, and became very famous out of it. So the question I want you guys to answer to me after, because I'm going to stop now, is the following. was that a good thing or a bad thing that those people had this idea? So in the press, you read lots of people say it was a horrible thing because that imploded the market. Okay? And I want you guys to think about it, having everything that I said here, where you have an opinion whether there was a good thing that they created this, okay, or was a bad thing. The outcome is everybody's in agreement. There was so much of that stuff that eventually Düsseldorf didn't want to buy it anymore. Prices fell, right? Some people had borrowed money to buy this stuff, couldn't pay it back, and the whole thing imploded. Okay, that's for sure. So the implosion of the mortgage of the credit bubble is very much tied at this new supply that appeared all of a sudden. I should tell you, legally, it was very difficult to create this new supply. That was the reason it took a long time for people to figure out how to do it legally. They needed changes in the legislature, which of course they lobbied for. They needed changes in regulations, which are done by regulatory bodies, which are not like the Congress or anything like that. But again, they have the force of law. They need a lot of those things to happen before they could create these synthetic CDOs. But think of it, creating this piece of papers without any houses being built in Arizona. Okay?
Well, I was wondering if you had any insights as to what might determine which asset classes are prone to bubbles. Is it something to do with new technologies and therefore being inherent uncertainty? So there's a lot of heterogeneous beliefs. Is it to do with supply elasticities, which is kind of something about like why Arizona versus,
yeah.
You know.
I think both things play a role. I think according to this theory, first of all, you have to have some reason for the heterogeneous beliefs. And I think lots of people agree about a lot. It's easier to have heterogeneous beliefs about new things. Okay, there's a lot of stories. One interesting thing is that you look at something that's like the South Sea bubble, even the South Sea bubble. South Sea bubble is an incredible thing if you look back today, because the South Sea Company had only one asset to start with, which was they had the monopoly of trade between the United Kingdom, it was already United Kingdom, 1728, it was already United Kingdom, and South America. South America at that time was understood as being anything up to Mexico, were basically the colonies of Portugal and Spain. But if you read the history, they had just finished a big war in which Spain, the war wasn't Spain, but it was really between France and England about the succession of Spain. And the current royal family in Spain was the one who was put in power. They were French, they were Bourbons. So to have a monopoly, to trade with a country which you've been essentially at war, the war was just about finished, doesn't sound like a very valuable asset. But people were very excited about it because South America was this great thing. And in fact, they were making money in entirely different ways. They were buying British debt, and it was really a financial derivative game. But there was a story behind it. And I think that's important. But the second thing is supply elasticity, because if the supply can increase very fast, it's very hard to sustain a bubble because people produce that stuff. I think an example, one that came out very fast, was Bitcoin. So Bitcoin was something that people were very excited for a while, but then people realized you can always create cryptocurrencies out there and so on. So at Columbia, I have some students doing their senior thesis on Bitcoins, and there's a lot of interesting facts about the Bitcoins, but they fit the stories.
So if it was very easy to short a bubble, would we have bubbles, or would it be pricked much sooner?
Yeah, it would be pricked much sooner. That's why all this idea, when governments put very strong restrictions on shorting, for me, those are like bubble-making machines.
So no easy shorting, no bubbles. But credit default swaps were, in a sense, going short.
Yes.
And if you had you could do naked trading on credit default swaps, and that'd be providing information
yeah. But it was very difficult, for instance, to short particular CDOs. You know, the problem is that where was the demand? The demand was in bonds. You know, the whole trick of the CDO is that you transform something which is essentially a derivative into a bond. Legally, it's a bond. A German bank could not enter a derivative contract with Goldman Sachs, but it could buy a bond, which was a CDO.
But you also get a credit default swap on it.
Yeah, you had credit default swap, but it wasn't the same market. That was not the market for which you had demand. Okay. You could, in fact, you could try to short the CDOs, but that was a much more complicated thing.
Yeah, I agree.
We can talk about that.
From a policy standpoint, could government maybe subsidize prediction markets on the future value of stocks or case-shiller index, for example, so that would be easier to?
I don't think the government needs to subsidize any of that. I mean, people make a lot of money if they can predict well anything, you know. Look at Nate Silver. He's doing very well. So I don't think it's your former student, right? Former student here. So I don't think you need any subsidies, but clearly it's, you know, those things help. I mean, the more information you can get, the more people can get, the less people will be able to disagree about. But it does take a market, it does take a situation where people believe these predictions.
I have a question about the costly shorting assumption. So I can imagine that us, as retail investors, face a lot of friction, a lot of cost to us shorting assets. But I can also imagine that large financial intermediaries, there might be like large hedge funds, large investment banks that face much, much, much lower costs or no costs to shorting assets. So I wonder, how would things change even if there was just one firm that could short without shorting costs? Would they be able to?
And with infinite capital.
And so
With infinite capital.
The infinite risk bearing.
Yeah. They wouldn't be paid. So the puzzle is this: empirically, as I say, people get very well paid to short, especially in situations where there's already a lot of short. I mean, we don't have a lot of evidence except in the stock market, of course, but that should be the best example where it's relatively easy to short. Even a retail investor can short. He has to pay something, he has to but at the same time, it should be understood that no matter how well-to-do you are as a hedge fund and so on, you know, if I short Apple Computer, what am I doing? I'm promising you the payoff of an Apple Computer share. Now, the only person can really promise that is Apple Computer. So there's a certain amount of always uncertainty, and that's why everybody requires margins, they require, and so on. But you're right, people have access, and that's why I'm a believer that the question of shorting goes beyond just the mechanical costs in certain markets. It goes up some kind of risk that people are facing. If you understand how shorting works, even when a hedge fund shorts, they borrow the stock, and almost by law, almost everybody, most of the stock which you can borrow are from institutional investors, and most institutional investors are by law forced only to make stock loans which are callable immediately by regulation. So if a mutual fund, which are the big supplier of stocks for shorts, if a mutual fund lends you a stock, you can say, look, I want to do this for a month. But in the contract, it must say, this is callable. And so there's a risk that somebody calls and then has to find somebody else who holds that same stock and so on. So there are risks embedded into that. But you're right. I mean, part of it we don't really understand. It's very easy to understand why it was difficult in CDOs. I mean, I'm issuing you a bond. I have to go, if I want to go short a bond, a particular CDO, those bonds existed. Each one of them was slightly different than the next one, and they exist in very small quantities. So the chance I'm going to find somebody to buy that bond if you ask for delivery was very, very tiny. So that's why people didn't do that. Over time, more and more instruments that increase supply, you know, the ABX index and so on, that help people, and that's in fact is all part of the story that I told.
So this will be the last question.
Last question, the boss.
I think I'm a bit unclear with the mechanism through which heterogeneous beliefs increase trading volume, because it seems to me like it's a one-time thing, or otherwise we would have to be receiving new signals all the time.
Exactly. Yeah, in the theory, the signals are being observed all the time, and these signals move. So it's like technically, you know, you're filtering some value from some certain set of signals. And if you understand the theory of the way you filter signals, is as they move around, you change your opinions too.
But then it seems to me you would have to be kind of schizophrenic to increase the trading volume, so that we would have to get a good signal followed by a bad one.
No,
First you buy and you sell, and the
it
other-
doesn't really matter. Whatever volatility the signals have, and whatever sometimes you're going to go without trading for a while. You know, remember, there's lots of people doing different things, and not that you are continuously trading. But if there's like 100 from us, okay, then maybe at some point you trade, because somebody else became relatively more pessimistic than you, so you cross that person. not as simple as that because you have kind of an American option, so you may wait for a certain distance, but you get to that distance with some person you trade, and I'm going to trade with him at some other date, and things will happen like this. And everybody has volatile opinions, but that's true in reality. I mean, if you ever traded stocks, now at this moment you think is a good time to buy it. In my life I've done several things, including being involved in activities related to trading, and your opinion changes. Today you think it's a great buy, and tomorrow you don't think it's such a great buy anymore. But somebody else might think it's a great buy because they're buying it for you sometimes at a higher price.
And so through the filtering, we're assuming that there's no convergence at all to...
Yeah, the problem is that we're looking at, exactly, so that's what I said. We look at relatively short phenomena. I think that's not reasonable if you think of something that's going to last many, many years. But we're talking about phenomena that's relatively fast frequency. Now, of course, if you really want to be good about this, you'd like us to think about, some forms of convergence, some moderate convergence, but still seeing happen and so on. But that's harder to do. I think that's it.